This is the entire October update of my stock market portfolio. For the past month, this portfolio is up $3,498.20. For the past 3 months, it is up $5,447. For the past 6 months, it is up $10,400. And for the last year, it is up $19,789.97, or 17.67%. For my individual accounts, the TFSA, or the tax-free savings account, which essentially means any money that I withdraw from this will be tax-free. No matter how many gains I make, they're all tax-free, is up 3% in the last month, or around $2,000. And for the last year, this is up 26.24%, or $14,163. My RRSP, the Canadian version of the 401k, is up 2.4%, or roughly $777 in the last month. For the past 3 months, it is up nearly 4.25%, or nearly $1,300. For the past year, it is up nearly 10% and $2,800. Same story for my FHSA, or my first home savings account, an account made by the Canadian government to encourage people, specifically first-time home buyers, to start saving, is also up nearly 3% in the past month, nearly 4.7% in the past 3 months, and in the past year is up 19%, or $3,000. So these $3,000 I can withdraw tax-free and apply that towards a down payment for my first house. And my last big account, the non-registered, is up 2.38% over the last month. Similar story here. Last 3 months up nearly 2.64%, and the past year it is up 2.31%. But you will notice I only started contributing to this during the last few months, since I was trying to max out my TFSA and my RRSP. On to the buys. My biggest buy remains the S&P 500, or the 500 biggest companies in the United States of America, returning an average of 10% over the last 40 years and even beyond that now. I add to this position as much as I can, buying $400 here and then also $400 again, I believe. Yeah, I bought nearly $1,000 worth of VFB, since I do believe in the long-term growth potential of the US market. Tech is in the US, manufacturing is in the US, chips are in the US now, and not eating chips, but chips that go into your computers that Nvidia makes. Extremely diversified and looking good for the long term. And adding on to the S&P 500, I also bought the NASDAQ 100. These are once again the 100 biggest companies in the United States of America, the biggest economy in the world, flag bearers of capitalism. This is very tech focused, with a large majority of holdings lying in a few companies concentrated at the top. But if you do think tech is going to add value, which I think it is in the future, it does return more than the S&P 500. If you have time to withstand those drawdowns and those peaks and valleys when it comes to tech, I thought it was a good option for me, so I added more to my NASDAQ 100 position. I also solidified my tech holdings by adding Google, which is a tech giant, search giant, and also social media giant. I'm making this video on YouTube, also doing really well in the cloud sector, with Google Cloud increasing in revenue exponentially over the last few years. Solid leadership, solid future outlook, good enough for me to buy one share off. And speaking of solid growth and future outlook, I also bought American Express, ticker symbol AXP. This is a credit card company focusing mostly on travel. American Express is much smaller than Visa and MasterCard, which are more widely accepted, but they have a very carefully curated niche, which is travel, and perhaps even luxury travel. With things returning to normal when it comes to traveling, booking hotels, booking flights and destinations, American Express does have good potential for the future. They're also steadily increasing their dividends in the future, which is something to look out for this company as well. Not to mention great profit margins. Credit cards are essentially low-cost companies anyways, but they've been steadily increasing their profit margins, increasing their revenue, and I think they're going to do well as soon as travel returns to those normal levels and even exceeds that. Travel spending is not going to go anywhere as long as people are alive. They're inherently going to want to travel. Speaking of the S&P 500, I also bought USSL. This is essentially a leverage ETF, which means that the returns are magnified, but also the losses are magnified. For a simplified example, let's assume the S&P 500 goes up 10% every year. This ETF applies 25% leverage, which means that if I buy this ETF, it's going to go up 12.5% minus leverage costs, because the ETF provider has to pay for leverage, i.e. they have to pay an interest rate for getting leverage. And let's assume the interest rate fee is 0.5%. I'm going to get a 12% return when I should have gotten a 10% return because they took on leverage. But on the other side though, if the market drops 10%, I am going to lose 12.5% plus leverage costs, so around 13%. And that's why I added on to my position in a very tiny manner, really only $65, but still enough to keep me interested and see where this goes over the long run. If it does well, I might add more to this position. Speaking of leverage ETFs, I also bought this ETF, HEQL. This ETF essentially tracks the S&P 500, but also a small percentage of the Canadian market. Before we dig deeper, if you enjoyed this video, please smash the like button and the subscribe button. If you like learning more about money, how to save more or invest more, or just understand it better. 50% of the holdings are US based, 30% are Canadian, and 20% are other markets. This is a more balanced approach, and Vanguard and other providers have products like this without leverage. Once again, I chose leverage with this because I do believe in the overall growth of the stock market, not just for the US, but also Canada and other countries. So this takes 25% leverage and adds on to that growth. Once again, the drawback is if global markets and the US markets tank, this is going to tank even more. Although I am young right now, like I've said before, I do think I can withstand those peaks and valleys and hold for the long run. So $100 got here. My last big US buy was Pepsi, around $250. Pepsi has not performed well in the past year. It has been stagnant. But I do believe in a few things here. Number one, Pepsi's revenue has been steadily growing over time, and by over time I mean literally decades. Their dividends have also been increasing steadily at a rate of around 7% per year, and they do boost a dividend yield of around 3% now, which is considered high. And at a growth rate of 7%, they will technically, if they continue, double their dividend in 10 years. So by the time I'm in my 30s, this should be paying me 6% and also be growing at a steady rate. Steady profit margins. They have a ton of products. They're always buying and acquiring new brands to add on to their portfolio. They have cash reserve on hand, and I suspect with interest rates going down now, consumer spending is also going to increase as consumers have more disposable income. They're going to be able to expand easier into international markets by easily acquiring more debt. It does look like, for me, a good hold for the long run, and that's why I bought one share worth around $250 for Pepsi. My last US buy was a covered call ETF. Covered calls are very controversial on YouTube and the investment community in general. They sacrifice some long-term growth to give you dividends now, and for me this is more of a motivation play. Seeing my dividends go up for these covered call ETFs is a huge motivating factor for me to continue investing, continue being a good saver, and continue being disciplined, because the stock price I'm not going to realize until I sell it, but dividends I see deposited into my brokerage, into my bank account technically every single month. Not a lot here, as you can see. It's only $100 compared to thousands of dollars that we've put for growth ETFs. Yeah, more almost like $2,000 that we put towards growth. So not a large percentage, but still enough to keep me interested and keep those dividends coming. I think I'm up to around $90 per month in dividends for this ETF. Although the growth rate is much lower, it's still growing, it's still giving me dividends, and it's still keeping me motivated. Switching to the Canadian market, I bought VDY, an ETF tracking the TSX 60 or the 60 biggest companies in Canada. This ETF is primarily focused towards balancing growth and dividends. The dividend yield for this is extremely high at 4.something%, 4.5 to 4.9, and the growth has also recovered since Canada has decreased their interest rates compared to the US rather quickly, boosting the stock market and investment markets in general, while still having a great dividend yield. Once again, solid blue chip holdings, not going anywhere anytime soon. Good enough for me to spend around $334 investing in. And not just VDY, I also certified my Canadian holdings with individual companies. BNS, or the Bank of Nova Scotia, one of the 5 biggest banks in Canada. This was beaten down a lot in the past few years because of the high interest rates, but now with interest rates decreasing, its price has recovered tremendously, and I don't see this recovery stopping anytime soon, since there are more forecasted rate drops, which is going to benefit not just BNS but other banking stocks as well. BNS I like in particular because of their international expansion, particularly in South America and Central America. I think that is going to be a good play as more of the economy there becomes formalized and more people rely on banking and technology to get their banking done, especially with interest rates falling. They're also going to get lower defaults now, higher profit margins. Once again, this is also a dividend play. Their dividend was extremely nice at around 6.something%. They're going to keep on growing this. Profit is going to keep on growing. It's banking, stable, blue chip, one share. My next biggest buy was Manulife Financial, which is an insurance company, one of the 3 biggest in Canada. With the amount of people coming into Canada, insurance is going to keep on growing. And once again, I like Manulife Financial for their international expansion as well, especially their Asian expansion, which has paid dividends for them in terms of the stock price in recent years. Good enough for a couple of shares to certify those holdings. My last individual company buy was TELUS. TELUS is a telecom company, also one of the 3 biggest in Canada. It's almost like Canada is just an oligopoly, one big oligopoly. But with interest rates going down, these telecom stocks tend to be very interest rate sensitive just because their expansion with buying all these cell towers and other technology has to be financed through debt. And with lower debt costs, they are going to see an increase in profit margin. My last buy was a covered call ETF tracking the TSX 60 called HDIV. This is once again a covered call ETF, sacrificing some of that long-term growth for income now. Only $86 compared to my other investments. That doesn't seem like a lot, but those dividends keep on snowballing and keep on rolling in. The holdings are still strong here, still blue chip Canadian companies that are a cornerstone of the Canadian economy. And we'll cover this in the return section, but this also has returned me relatively equal to the TSX 60 just because it also tracks some blue chip US sectors as well. Speaking of sales, no sales to report since I do hold for the long run, and I do think 20, 30, 40 years down the line, most of these companies, since they are ETFs or bigger companies, should be okay to hold. If I do see some red flags, I might sell, but they're doing good for now, so no sells, hold for the long run, and see where this portfolio takes you. But how have these holdings actually performed? My biggest holding, the S&P 500, is just up across the board. It's up 32% in my TFSA, which is my oldest account that I've been investing in, and it is also up 2% in my non-registered, which is the newest account that I've been investing in. Up 12% in my RRSP, 21.8% in my FHSA. Really good performance over the last 2 years. If you believe in the US market, I don't see this decreasing anytime soon. My second biggest holding, or VDY, is also up huge, up on average 13.5%, with some accounts being higher like the FHSA or the TFSA and some accounts being lower like the non-registered. This has seen a nice recovery since Canadian interest rates have been cut, and a lot of people told me not to invest in VDY or the Canadian market, but I just don't see why not. The Canadian population is increasing at a rapid rate. This ETF holds blue chip companies, services that everybody needs, not just newcomers, but also people that have been living here for a long time. And as the cost of services increase, the population increases. What do you think is going to happen to the stock price? What do you think is going to happen to the profit margins of these companies? It just makes sense for me to invest in this. HXQ, or the Nasdaq 100 ETF, is also up huge at around 7%. This is a newer investment. I primarily choose to invest in the S&P 500 for all the reasons that I've mentioned. But this tech-focused ETF has seen a huge drawdown in the last few months, still up 7%. And my last big ETF holding, HEQL, or the All Equity Enhanced ETF, is also up 6.7%. So you can see the performance is similar to HXQ because the tech market has been slightly down, but the Canadian market has been up. With that extra leverage that we talked about, leads to a relative tie in performance. And my smallest ETF holding, USSL, the leveraged S&P 500 ETF, has returned me 1.48% so far. My biggest individual holding is Apple, returning me 32% since I started investing. Sticky products, we've all heard about the Apple ecosystem. Everybody needs a phone. The MacBook is the best laptop out there for any purpose. I don't think you can convince me any purpose that it's not good at, except gaming, I'll give you that. Microsoft, the second biggest individual holding, is up 22.39%. Microsoft Azure doing extremely well, and products that have been around for decades and will continue to be around for decades. Pepsi and P&G, two different tales. P&G has returned 15%, but Pepsi is down minus 2.25%. The investment philosophy for both of these is similar. It's more dividend growth focused. Both of these companies have been steadily increasing their dividend over time, and I do want to get paid around 5 to 6% by each of these in 15-20 years. With that modest stock growth, you can already see P&G is returning me an average of almost 8% a year, and Pepsi, although down, does look like a good hold for the long term, even if you just look at it from a dividend growth perspective. Google up 10%. This has been my worst returner of all the tech companies that I bought. Although similar to Microsoft, extremely good cloud revenue. As long as there's things to sell, there's going to be ads. That's what I always say, and I'll stand by it. And extremely good potential for the future when it also comes to products like their Pixel phones and hardware. AXP, American Express, we talked about this, credit card giant, especially in the travel space, a space that I really love, especially luxury travel, up around 11% for me with growing dividends as well, growing dividends at an average of 10% over the past few years. Only $1,000 invested for me right now, but this is going to be a steady position in my portfolio, and I'm going to increase it every chance I get. Well, if I get more money, I'll put some towards this. My biggest Canadian holdings include BNS, the Bank of Nova Scotia, around $4,000, returning me 14% nearly. A lot of people don't like bank stocks, but I think it was a good time to buy when rates were high. When do you want to buy stocks? When rates are high and stocks are low, or when rates are low and stocks are high? I think we need to be smarter with our investments. People are chasing 4% returns on savings accounts when they should have been buying bank stocks, in my opinion. But what do I know? I only have a return of 14% over 5%. So not even taking into account dividends, I've tripled their return basically if you had invested in a savings account. Sorry for that tangent. Manulife Financial, $2,000 here, up 40%. Once again, should have been buying when it was down. Anytime's a good time. You cannot time the stock market. I don't give financial advice because I'm not a financial advisor, but there's just no good time to time the stock market. You just have to invest. And TELUS, nearly $2,000 here as well. It is down 6%, but if you take into account dividends, which this was returning around 7% for me in dividends, I am up from a total return perspective. But once again, these stocks are down, especially these telecom stocks, because rates are up and they're heavily rate dependent. A good time to buy is not when rates are down and these stocks are going to return to their all-time highs, just because that's just how this works. If it's easier to finance debt for them, it's easier to expand and increase revenue. So it's down for me, I understand that, but I expect that, and I expect it also to improve in the future. Some other smaller companies also include CIBC, Enbridge, and BCE. I haven't added to these positions in a long time, not a lot of money in this, just stable companies to give this portfolio a slight yield boost. HYLD, or the ETF tracking the S&P 500, has returned me 13% nearly, 12.5%, and HDIV has returned me 10.5%. You have to understand this. This is 12.5% plus the dividends that I've been getting for 2 years. And the yearly dividend yield for this is 12%. So you have to add that onto the performance. Like I mentioned before, these ETFs are growing not just in dividends, but also in stock price appreciation. My only crypto holding, Ethereum, is down 17% nearly. This was down around 30% the last time we did this, so I guess I made 10% during the course of the month. Once again, a very long-term hold. If crypto does end up solving real problems in finance or other dinosaur industries, it's going to take a long time, so I don't expect a lot from this in the short run. I do think I am young enough to take this risk and see where this goes in the next decade. And no, the number in the video is not inaccurate. I also have a work RRSP. A lot of companies in Canada and the US provide RRSP or 401k matching up to a certain amount. This essentially means if you put in 4% towards your retirement, the company matches that and puts in 4% for you, giving you an automatic 100% return. I take part in this, and I also encourage my friends and my family to look into this as well, just because I do think 100% return on investment, somebody matching your investment, is a pretty solid return for an average investor like myself. As you can see, I put in $10,300, my employer has matched it with $10,300, and with a steady and solid growth of around $4,000, we get this balance of $24,791. Moving on to my favorite portion of the video, and perhaps some people are also looking forward to this, is the dividends portion. This portfolio now pays me $4,248 in dividends with a rate of $354 a month, $11.64 a day, a portfolio yield of 3.23%, and a yield on cost of 3.7%, which essentially means my portfolio has gone up in value as we've seen. This is getting big now, with some months paying me nearly $500 in dividends. $500. I can't even believe. I don't even believe I'm saying that. But some months also pay lower at $285, for example, but it averages out to this $354 a month that you see here. My biggest pair is once again the covered call ETF, HYLD. This ETF tracks the S&P 500 that now pays me $1,000 a year in dividends. $1,000. BDY, or the TSX 60 ETF, pays me around $900, and some other bigger ETF pairs include HDIV, the covered call ETF tracking the TSX 60, paying me around $800, and the S&P 500 ETF paying me around $400. Individual companies like BNS, TELUS, Pepsi, P&G, BCE, Enbridge, Manulife also pay me decent dividends and are a part of my investment philosophy in why I actually invest in these companies. Tech companies like Apple, Microsoft, and Google also pay dividends, although not at a very high rate, but the growth rate is high here, and who knows, maybe 10 to 15 years down the line, this 0.9% becomes 3%, which is the same as Pepsi right now. So investment philosophy is different for each of these. It's just good to see dividends coming in and the high growth rate of dividends. So that was it. That was the entire breakdown. As always, smash the like button and the subscribe button if you enjoyed this video. It really helps the channel out. It helps with the YouTube algorithm, helps me reach more people interested in finance and just transparency in general, because there's a lot of BS online when it comes to making money or saving or investing or anything finance related. I'll see you in the next one.